I think the reason they haven't revalued it is because they want to keep gold out of the public conscience, because if they revalue, people are going to realize that the emperor dollar has no clothes, and that gold is the ultimate reserve asset.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 1st through September 8th, 2025, while supplies last. 1 ounce gold Pamp Fortuna Veriscan bars are $99 over spot per ounce. 10 ounce silver Royal Canadian Mint bars, $2.49 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Mario Innecco from the very popular Innecco64 YouTube channel. Mario, thank you so much for joining us today.
You're welcome, Elijah. Thank you for having me on again.
Well, it's great to have you today. I did want to discuss, what we're seeing in both gold and silver as gold breaks out to new all-time highs above 35.50. We're recording this today on September 4th, so we're seeing a slight pullback today, but also silver broke through the $41 level yesterday. So your take on these moves, and what do you think are the key drivers?
Yeah, I mean, the first one, technical analysis-wise, we had a big move in gold at the beginning of the year. We topped at 3,500 in April, and I guess the market took a breather for over 4 months. And usually these consolidations, they end up, especially a bullish one, end up breaking back out towards the upside. The chance of it breaking down is like 1 in 4. So technically, is just confirming the formation. Fundamentally, I guess it's related to all the turbulence in the world, geopolitically, I would say, and the fact that BRICS are getting more and more united, especially after India kind of made up for now with China. That will accelerate Dedollarization, and also all the debt in the West, government debts, that's weighing on the bond market, and I think that's helping gold. And I also think the economies, not just in Europe and in the US, are slowing down. And the economy that slows down, that means less tax receipts, and that means more fiscal problems. So I think it's a combination of those things. Silver has kind of late in the last few weeks was leading gold. I think ever since we broke like 35, 36, that confirmed the breakout. Yeah, so I'm very bullish silver, even more than gold. That doesn't mean I'm going to sell my gold to buy silver, but just keep trying to buy both.
No, definitely. The ratio for gold to silver has been falling. It was over 100 to 1 just a few months ago, but now it's around 85 to 1 or so. So we're certainly seeing silver outperform here, and hopefully that continues. I did want to ask you about the sovereign debt crisis we're seeing. It seems like across the globe, yields on long-term sovereign debt are increasing. We see this in the US, we see this in the UK, and especially in Japan as well, on their 30-year notes. So your perspective on this, and is it it seems to be, if it was just the US, that could be like, well, people are giving up on the dollar, right? But if it's across the globe, it seems like it's more a loss of confidence in fiat currency itself.
Yeah, I agree 100% with you, because long-term bonds are just fiat currency due in 20, 30, or 50 years. So the higher the yields go, that means investors are selling those bonds. They don't have as much confidence, and if they're going to buy them, they want a higher return. And Germany as well, they are at 15-year highs, I think, the 30-year there. I mean, the last couple of days, we've seen a little bit of a rebound in these bond markets. So yields have gone back down slightly. I think there's been intervention almost every day in Japan by the central bank. The Bank of England intervened as well. So they're going to try their hardest to keep this from getting worse. But I don't think it's going to work. I think the markets are bigger than the central banks. And I don't think we are out of the woods. And September, October are usually seasonally not very good months for currencies and bonds. So yeah, I would keep an eye on that. And I think, like you said, Japan is like it is a big part of this, because their yields have gone from being negative to like the 30 years around 3.3%. Doesn't sound like much, but when you're coming from zero, that's a lot.
Recently, you were talking about a book by Edward Chancellor, The Price of Time, and he really dives into interest rates and even some negative interest rates we've seen in recent years. And he explains how really low or negative interest rates can cause major issues, right? It kind of distorts the economy and distorts people's time preference and all of this and how they save. So do you want to kind of dive into that? How have we been living in an artificial economy where people's choices are really being, people are making, this is really hurting the economy because it's distorting things so much?
Yeah, and what the artificially induced interest rates have done, especially from like 2008 to like 2020, 2021, is that it's encouraged people, corporations, governments to take on more and more debt because rates kept moving lower. Like even before 2008, we were in a downward cycle for interest rates. So it was really easy to take on debt because you could roll over that debt at a lower cost. And that drove asset bubbles, that drove real estate bubbles. And it made people really, it made it so people thought everything, and still think, I think to some extent, that everything is easy to get, that you don't need to do any work. You just borrow, speculate, and you spend and keep repeating it. And it's not natural. And the central bankers are to blame for that because they pushed this policy of zero rate and QE. And unfortunately, Elijah, all good things come to an end, and then interest rates will revert, not to the mean, but it will go through the mean, which, looking at that chart from that book, seems to be around 5% for the last few hundred years. I think we're going to blow right through that mean. We're already near 5%, and we could even see double digits interest yields in the next few years. And basically, that's payback time really for the decades that we've had of easy money and living beyond our means.
And where does this leave people? Because obviously low interest rates really encourage speculation. It encourages then asset prices to go into bubble territory, which is probably what we're seeing right now in the stock market. So what does this mean going forward? Then it seems like if we're probably going to see higher rates, which is going to hurt people a lot. And we're also going to see falling asset prices in the stock market potentially. So the main assets out there, the main investments for people out there, stocks and bonds, are going to be doing incredibly poorly if we do see higher interest rates and collapsing stock market prices.
Yeah, on a personal basis, I don't think it's the end of the world. People are just going to have to adjust to being more frugal, working harder, saving more, and doing less and spending less. I mean, going back to like 50, 60 years ago, when the credit bubble wasn't there. In terms of the markets, It's not the end of the world either, Elijah. I think it will bring back what some people call value investing. There will be places where you can invest that you will do well, but you will actually have to do some work and research. There might not be as much capital appreciation and bubbles as we've seen the last 20, 30 years. So, yeah, to some it will seem like the end of the world because they've been around only, not a very long time, and they don't look at history and realize that things go in cycles. So, yeah, that's how I see it.
Certainly. And I think coming back to the top of this interview, as we were talking about higher gold and silver prices, this is just highlighting kind of the risks out there. We're seeing a loss of the confidence in currency, but also just greater economic and geopolitical risk out there as well at the moment.
Oh, definitely. And I think the summit you had in, I think it was Tianjin in China for the Shanghai Cooperation Organization was like a big turning point because India attended and Modi attended for the first time in 7 years. And it looks like India, China, and Russia, the big countries in BRICS, are very united. And then you had this military parade commemorating the end of World War II in China. And Xi Jinping was really flexing his muscles there. So, yeah, and talking about a new order, Chinese order or BRICS order. So, yeah, that really, in my opinion, will accelerate de-dollarization even more because these countries, even though they're not going to get rid of all their treasuries right away, they're going to try to accumulate more and more gold because gold is the only neutral reserve asset, even though I think the yuan will be a very important currency for these countries. So that's what's going on, and it will be interesting to see how the U.S. Reacts to this, because it's a challenge to U.S. power, and hopefully it won't result in any conflict. Maybe, hopefully, it will result in some kind of cooperation and more of a multipolar world.
In what kind of time frame do you see with respect to dollar devaluation here? Because if the dollar being the world reserve currency has been a great thing over the last few decades, as the U.S. has been able to, essentially get more goods and export its inflation. But if that trend reverses, it becomes a huge liability, right? Because countries then start selling their massive dollar holdings, their U.S. treasuries, all of that. And a lot of that inflation would come back to the U.S. And I know back in when the U.K. had the British pound as the world reserve currency, as that started to turn over towards the dollar having the world reserve currency, a lot of British pounds then came back to Great Britain. It wasn't like a hyperinflationary event, but it was decades of, really high inflation and the pound losing value. So do you see this as kind of like a decade, multiple decades that we're just going to see the dollar decrease in status here? Or do you see, and we're going to see high inflation, or do you see it kind of being an all at once moment where we could even see extremely high inflation or hyperinflation in the US?
That's a good point about the British pound, because it was only in 1954 that the dollar took over the pound as the major reserve currency. And we saw recently Tavi Costa published this chart that gold reserves for foreign central banks have overtaken treasury reserves of foreign central banks. So it looks like we're in 1954, so to speak, for the U.S. What I see happening is continued devaluation of the dollar, especially versus gold. And unfortunately, a lot of dollars are going to come back to the States, and that's going to make things a lot more unaffordable for people, and that's why. And I think the Trump administration knows this, and Stephen Miron, he's been appointed as to a post in the Fed. His main theory is to devalue the dollar. So I think they are going for that. But at the same time, they're pushing for reindustrializing the U.S. As a way of maybe softening the blow so that, yes, people are going to be hard up a bit more, but if they have new jobs, it will help. Whether if we have a hyperinflation or not, I mean, that's still up for debate, even though I think we're very close to it. It all depends, I think, as well, whether this talk of revaluation is, if they really come out and revalue gold, if they revalue it really high, then we could see the dollar really, well, because revaluing gold really high means the dollar becomes worth a lot less. So, in my view, either way, one needs to keep a hold of gold and hard assets because it's the only way to keep moving is to devalue because the debt is so huge. The unfunded liabilities are so huge. And that's the only way out, short of just defaulting. And defaulting, I think politicians prefer inflation to default because default means like a Great Depression. No one has anything. At least in a high inflation, people can still buy things even though it's not that affordable, but at least there's currency going around.
And it is crazy just to see gold breaking the $3,500 level. I mean, that's 100 times where it was in 1971 when we went off the gold standard. When it was $35 an ounce, now it's $3,500 an ounce. So that's just an amazing realization that the dollar compared to gold, right? If you want to consider the dollar gold ratio has dropped 99% since we went off the gold standard, which is just a huge signal to the world that, the dollar is not immune from, high inflation and devaluation.
Yeah, I think that's what the world is waking up to. And that's why central banks around the world are accumulating so much gold. But it's not just the dollar. All the major fiat currencies have lost like 99%. I think it's only the Swiss franc that has lost like 92 or 93, which isn't great either. But in relative terms, it's a lot better. I mean, even if you just go back 20 years, Elijah, it's like gone up 10 times, really, it was, even more than 10 times because the low was 250 back in the early part of this century.
With respect to de-dollarization as well, and we were mentioning, the high interest rates out there, it was just broken by the Financial Times actually just a few days ago, and I think you reported on this as well, that some countries are actually turning to other currencies like the yuan or the Swiss franc, just because interest rates are lower and it's easier to borrow than it is to borrow in US dollars at the moment.
Yeah, there's a lot of countries, like especially the emerging market and countries like Kenya, who are swapping their dollar debts for yuan or Swiss francs because the rate of interest in yuan and Swiss francs is a lot lower than the dollar rates. I guess there's still a lot of dollar-denominated debt for the emerging markets, but it's a trend that's growing. The only let's say the other side of the coin of this is that these countries, they're paying less interest, but the currencies that they are borrowing in, like Swiss franc and yuan, they might appreciate too, and that makes it harder for them to pay it back. So it's a double-edged sword, but as for what it means for the dollar, it means that there will be less demand, especially in times of crises when liquidity dries up. The dollar might not rise as much as it used to in the past because countries won't be needing as much dollars to pay debts.
Certainly. And I guess going into the end of the year here, what kind of movements do you see in gold and silver? Obviously, we've seen a huge run already, but do you have any thoughts on where we could be in the next, 4 or 5 months?
Actually, it's difficult to give levels, but I have a feeling that gold and silver are going to surprise on the upside because this breakout is quite significant. And so I mean, looking at the technical picture, if you measure like the move from the beginning of the year to April in gold and you extrapolate it from the breakout, it gives you 4,300. But it could be even more in the next 4 to 5 months, I would say. I think Goldman Sachs has come out and they said they could see 5,000 if the market loses confidence in the Fed. So anything's possible, but I wouldn't want to be short gold and silver. Anyway, I don't recommend people go short gold and silver.
No, certainly. And you mentioned concern about the Fed as well. I mean, that has been in the news lately with Trump firing Fed governor and really putting pressure on Powell. And I guess my perspective is, well, we should question more about whether the Fed should exist or not, rather than should it be independent. But I think the fact is that the market is seeing that if the Fed loses its independence, then it'll be more susceptible to political pressure. And that probably means more inflation because politicians like spending a lot of money. But your take on that whole dynamic right now between Trump and the Fed?
Yeah, I agree with you. We don't need a central bank in the U.S. nor here in England. But be as it may, the people in the markets, the traders, the investors, and hedge fund managers, they don't see things like us, and they do see this dispute with Trump as a threat to the Fed's independence. They think that the Fed has been great at controlling inflation, which I think is a joke. So, but yeah, it does affect things, and it will help hard assets. So, because I think what people are fearful of is that instead of their inflation being just 2%, it's going to be 3 or 4, and that doesn't seem a lot, but it is over time.
And last topic I wanted to discuss with you, I know you were talking with Andy Sheckman on your channel just today, and you guys were talking a lot about gold revaluation. I know a guest on your channel as well, Clive Thompson, has talked about this. What are your thoughts on the chances of that happening anytime soon, and what would it mean for the price of gold?
I think there's a good chance because even the Treasury, actually the Fed, their accounting manual earlier in May, they wrote about that. And in the beginning of August, there's an essay written by an economist for the board of the Federal Reserve talking exactly about that. So they are thinking about it. What it will do to the price is put a floor at the level that they choose to revalue it to. Right now, it's at $42.22. Even if they were just to revalue it to $3,500, which is where we are right now in the spot price, that will put a rocket up even more, rocket up the gold price even more, because in 1972, they revalued from 35 to 38, and then the market just kept going up. And then they revalued again in 73 to the level that we have now. And gold took off and went to like 200 by the end of, I think, 1974.
It is crazy that the U.S. government is valuing gold at only, $40-some per ounce when it's really $3,500. So it seems like, I mean, at least revaluing to that amount seems kind of like a no-brainer move to me. What is your take on that?
Well, I think the reason they haven't revalued it is because they want to keep gold out of the public conscience. because if they revalue, people are going to realize that the emperor dollar has no clothes, and that gold is the ultimate reserve asset. So if you keep it there, it means you don't need it, right? It's just it's just pet rock sitting there, and it's useless. But if they revalue it, it's an admission that the fiat experiment has failed, and it was failing back in the early 70s, and that's why they had to revalue it a couple of times.
Mario, if our viewers are interested in learning more, they can go to your YouTube channel, Innecco64. You're also on X, Innecco1964. Did you have any last thoughts for our viewers, and can you tell us a bit what they'll find there?
Yeah, I mean, last thoughts. The world seems really turbulent and chaotic, economically, financially, geopolitically, but it's not the end of the world. Just keep your head down, enjoy your life. It's normal. Things go in cycles. And in terms of my channel, I publish a video every day on my channel. I'm doing a bit more interviews as well now, which is great. And we do a live stream as well on Sunday night UK time at 8 p.m., which is 3 p.m. Eastern time.
Fantastic. Well, thank you so much for your time today, Mario. We really appreciate it, and God bless.
God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 1st through September 8th, 2025, while supplies last. 1 ounce gold Pamp Fortuna Veriscan bars are $99 over spot per ounce. 10 ounce silver Royal Canadian Mint bars, $2.49 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.